could be YouTube channel, meetups, you could be doing Facebook Lives, you could be doing Insta or TikTok or whatever the new social media platform is these days. Whatever platform you choose, make sure you choose it based on the investor types you want to serve. Like we were talking about the returns before. I can give you a quick example. If we noticed the trend that we have different investor types, and some of our operators started offering two completely different options. So one is an option for people that are looking for immediate cash. They would be getting cash on an annual basis. It's sort of like preferred return. It's slightly higher, but these are the people that just want that repeat cash flow over time. And then on the other hand, we have a completely different group of people that are looking for long-term investment and want it appreciated the long term. So while they don't need the cash right now, whether it's because they're working, have a full-time job, or they're business owners and get the cash from that, but what they want to see, if they put 100 grand today, they want to see it double or even triple in value, let's say 10 years from now. So we do that by splitting the options into two different pools and saying, hey, you're a cash guy or girl, you want to travel, you need this cash coming in your bank account every month or every quarter, we'll give you that cash, but don't expect appreciation. This is all you're getting, that preferred cash return. It's slightly higher than the typical 7 or 8 we're talking about. And then on the other end, we have the good old-fashioned equity people that are looking for that appreciation long-term, don't need that cash in their pocket today, happy with appreciation, so we'll give them that. And by doing this sort of catering, we are retaining our investors for a long time, we're building the relationship, and we're also showing them that we're listening, which is one also very, very important skill. So a lot of people, what they do when they meet someone, whether it's investor or someone else, they talk to each other and they hear, but they don't listen because it goes out in the other ear. So what's very, very critical is when you hear someone to actually listen, make sure it's a conversation. When they're saying something, don't wait till they finish in order for you to jump in and say, I'm so-and-so and this is my story. Make it into a conversation. Make sure that you ask that person follow-up questions. Oh, you have a family, or you have 2 kids, so are they going to school, are they going to college? What are you like golfing, so where are you golfing? What type of golf cart are you using, and so forth. Show interest in the other person. Show that you're definitely interested in what they're talking about and that you really care. And it's not just about you and getting to know how much money they have in their pocket so they would invest with you. So at the end of the day, it's all about building relationship, like everyone else was saying. And no matter what other people say, it's an organic process. It's very lengthy. It takes time. So make sure you build those relationships and you show your true, authentic self. Because at the end of the day, people invest in you as a person. Nobody, is investing in a deal. They'll look at you as a person, and if they like you, they like what you're doing and what you're offering them, the next step for them will be to look at the deal you're presenting to them.
Awesome, thanks. So Dan, passive investors will come up and have a ton of questions for you, right? Ultimately, you do your best to prepare for them, but there are going to be times when they're going to ask a question that you might potentially not fully know the answer. What would be a good response to that investor?
I'm not a CPA, I'm not an attorney, call one of them. Again, circle back to my sales experience. I'm never afraid to say I'll get that information and get back to you, because the worst thing you can do is say the wrong thing and then it comes and bites you in the butt. And in this case, it could be stuff as severe as going to jail. Through the SEC. So I will always circle back to the operators or attorneys, etc., whoever's involved to get that answer, and I'm never afraid to come back because it's all about authenticity, like Dave said. I try and be as real as possible, and I'm not always going to have all the answers. And I don't think anyone's ever said, oh, that idiot couldn't even tell me this one thing. I think they appreciate that I'm making the effort. Let me circle back, because especially when you start to get to multiple deals at a time and everything else going on in life, I might not know something off the top of my head. I'm sorry, that one line item on the underwriting, let me get back to you. So.
Yep, and the important part here is, so Dan, getting the question, he may not know the answer, but what he's doing, it's also building his brand, is he's saying, I'm going to get you the answer, and then Dan's following up with that answer. Because people are looking to you that you're setting up yourself to do what you're going to say you're going to do, and that's going to build your brand out as well. So Dan says, okay, I don't know the answer, I'm going to get you the answer, goes, gets the answer, comes back, and here's the answer. So that's part of the repetition of really just creating a brand. Just do what you're going to say you're going to do. It's as simple as that. So some of the questions we get from investors is, do you have maybe a top 5 question list? Because people maybe haven't raised money for, and they're just so scared because they're worried about these questions, right? So, of course, there's an unlimited amount of questions that may come out there, but give us 5 questions that pop up that you, maybe questions you have rebuttals for, or maybe just questions that stand out a lot from investors that come to mind.
Sure. So like the top question that I sometimes get is, how confident are you yourself in the deal? How much money are you putting in the deal? How do you know how well do you know the operators, the asset managers?
Do you have to put money in your own deal?
It's better, if the money raisers and the asset managers put money in their own deal, that shows their skin in the game, and that also brings more confidence to the investors. Hey, they are not just taking our money, they are actually investing in their own deal and stuff like that. So I wouldn't invest in a deal, or I wouldn't raise money for a deal where the asset managers are themselves not putting money in their deals.
Yeah, it's awesome. See, then he's taking it from the other side. He's like, well, I invest in this deal, so he wants to be confident that he's bringing the right deals to people that he would invest in too. So remember, we all want to get started, but there's never the purpose that you have to get out there and just to get started sidestep something. You're going to stick with everything you're going to do from day one. Is going to be the same thing that, when David started, he's doing the same thing he's doing 15 years later. He's doing the same processes. He just has more systems built out to it. So we're going to open this up to Q&A. We had a lot at this point, so if you want, we can stand up, ask your question, put in there. If you have it specifically for a person, if not, we can just pass along the mic while each person just answer one question and move it along.
So you guys, the structure your deals. So what's the GP side and what goes to the GP side and what goes to the LP side. And do you put the skin in the game also, or you just raise for another people?
So, then you have the mic. Why don't you answer this one?
Sure.
Would you repeat the question? So he was saying in the deal, how are you structuring the deal between the GP and the LP? What is the percentage go to each party? And is there any skin in the game from yourself, which we did talk about a little bit here, so that's very probably wants money in the deal. So really, if you talk to it, you can structure a deal anyway. So we're not going to tell you tonight you have to structure a deal this way, this is the only way. You can structure a deal any which way under the sun as long as it makes sense for you and your investors. But they're going to talk to maybe the way they've done it in the past that may work for you, or you may find some formulation or some other way of it. So then just talk to the GP.
So, I'll talk about the last deal that we did. So the GPs put in about 10% of the raise themselves, and the LPs came up with the 90% of the raise. And pretty much the distribution is 8% preferred return and then 70-30 split. And then once the IRR reaches 15%, then the split becomes 50-50. So we are giving up to 15%, it's 70-30, and then once it becomes 15 for the investors, then we are doing a 50-50 split to the GP and LP.
And when's a point potentially that you could reach that hurdle rate of 15% during the hold? What could be a moment, maybe if someone hasn't figured out why that would happen, what could cause that?
That could be either a sale or a refinance event. So sure. That's when you could exceed 15%.
So they've executed the business plan. So ultimately, the business plan has been executed in some fashion. Either they're selling it and they're meeting their required returns plus, and so the deal would tier more into the GPs, or they've given a substantial amount of money back to the investors early in the deal from putting forward a business plan, refining, pulling money out, so the investors have limited risk downside now because most of their money's back, so now it's still the return's going to tier more towards the GP. Cool. Other question?
I have a question. I am currently in New Jersey. I have 3 properties over there. I'm fairly new to real estate. I moved from New York. And I just wanted to know, because I heard you guys speak about the operator being one of the key parts of that equation, but nobody made any specific mention to like the level of experience you look for, like the amount of assets they control, what they currently control. So me being somebody that's kind of a smaller scale, smaller tier, I'm very self-aware about what I can do and what I can't. It would be extremely beneficial to somebody like me to know what it is that you guys are looking for as far as assets currently managed or experience level, amount of years, amount of flips, whatever it is that you look for.
Sure. So I'll repeat the question. Dave, you have the mic. So ideally, in terms of an operator, when they're looking at an operator who's bringing them a deal, what kind of experience are they expecting, or do they want the investor to have, or the operator to have, to be able to go forward and potentially work with them?
I'll speak putting my lender hat on, and every time we make a loan to, when we do fix and flip or ground up construction, we're making evaluation on how comfortable we are that this person can navigate the project from point A to point B. And there's no absolute way to tell, but you've all met people, right, that the minute you meet them and talk to them and you know, 5 minutes in, you feel like they have that it factor, right? Nobody can necessarily describe it, but you talk to them, you understand that they're thoughtful, they know what they're doing, why they're doing it, and all those pieces. So it's really about understanding the person behind it. You know, there are young people that, I mean, that start tech companies that make, you know, billion-dollar companies, and you know, people take bets on them. And why do they take a bet on them? Because they feel that they're diligent and they're thoughtful. Like you said, I'm only doing these deals because I understand that I'm limited on my resources or my capital right now, but my goals are this, and this is how I plan to get there. So when you talk about larger syndications, you want to see that they've had experience before, whether they were working for a group and they were an asset manager, or they were involved in raising capital, or whatever piece. So you're trying to gauge these intangibles, and there's no, in my mind, absolute. It's about how they communicate to you, and you kind of have to trust your gut a little bit on that.
Yeah, very well said. So I look for a track record in business, right? Because ultimately, a lot of you in here want to do your own deals and be an operator. It's going to be your first deal, right? So ultimately, you're going to have to get across this hurdle sometime. So ideally, it's going to be how have you performed in other businesses, and who have you surrounded with yourself to be able to make the deal happen. Because you're going to be new at some point, but if you put on team members who have 5 years experience, 10 years experience, or have done deals before, even if you're the operator, well, now it gives you that much more, because now you have a cushion for people that can help you along the way. So, next question. Aaron.
When you guys do a refinance, you pay back the investor's cash. Do you consider that a payback principal, or is that profit?
So we're talking deal structure again. If there was a refinance during the hold and they're giving the money back, is it considered paid on principal or profit?
I'll pass. I just wanted to say real fast that most times on a refi, it's a return of principal, but another thing about the return profile is there's a treatment of capital. So when you're getting cash yields, some syndicators will treat that as a pay down of principal, which will boost your IRR, but what they're really doing is repaying your principal back. It's like a free loan, and then it boosts your returns. So like I say, sometimes in the lending side, not all return numbers are equal, or there's so much baked into an IRR, so trying to understand that. But usually on a return, on a refi or some kind of liquidity event, it's a return of principal. But I'll turn to whoever wants.
Lena, why don't you take that question? And then, yeah, it's important, like David said, it's a super good point, right? IRR is the return of your money and the velocity of that return. So if people are paying that in principal, it's just going to make the deal look better. When ultimately you want to pay attention, what are the actual mile markers of the money coming back?
So yeah, David actually already answered that question. It's return of principal. Not only it's that, it's a non-taxable event. So essentially, let's say you put 100 grand in a deal, and 2 years down the road, you're getting 20% back. Let's say it's $20,000. This $20,000 check is not going to be a taxable transaction to you. You're not going to be paying taxes on it because you're getting your money back.
Yeah, and so if there was a cash out refi above your initial investment, but you haven't sold, how is that treated and when would it be taxable?
If there was a cash out above your principal, I would love to see that transaction these days. So that would be treated, I believe, as capital gain, and it would be taxed at either 15 to 20%, depending on your overall portfolio.
So, yeah. So if you have to talk to your accountant, it can be done a couple ways. But people, when you're taking money out, ideally in a cash out refi, it's going to be, you keep rolling forward, but it's going to be taxed when you sell. So a lot of people go through. Questions out there? Sir?
The comment was made earlier that the decisions of high-wage earners, someone could elaborate because depreciation is passive, right? Or high-wage earners have to active income, so it's not offset. So I just want to understand because that could be a little misleading to investors.
You're talking about depreciation?
Yes.
Correct. So how is depreciation being treated?
How is depreciation help high-wage earners? Because that's the comment
Perfect.
made.
Yeah, how does depreciation help high wage earners?
It